Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Ross, today, Ross Kay Realty Consultants, the professional arm of your consulting business, released a foreign owner taxation policy called Right to Own. It seems extremely aggressive versus the current foreign buyer tax we have in BC. Can you explain the difference?
Yeah, well, the difference is that we had to set, when you're setting a policy, when you're going to enter the home ownership market, and you are going to look to get a change to take place in the market, you have to look at the whole market instead of one specific aspect. What I mean by that is that when the BC government brought in their foreign buyer tax, all they did is they applied a small tax for foreign buyers in the resale market. They left everything else unaddressed. A foreign buyer could go buy a brand new luxury build and not pay the tax. A foreign buyer could go buy a high-rise condo, not pay the tax. A foreign buyer who purchased the property pre-July didn't pay the tax. They just went in and put a little postage stamp or bandage over a problem without looking at the whole patient to see, what a better strategy would be to improve the health of the housing market out there. So when we come up with a concept, a strategy, we call this a policy framework, we have to look at the overall housing market. We have to look at how the participants in that market interact with one another, what behavioral patterns the participants have demonstrated over the last 50 years, and what is the probability that they're going to enact some sort of a bypass or some they're going to look for some way to get around the intent of whatever policy you put in place, which in this case is to keep Canadian homes in the hands of Canadian owners. So we didn't just look at this policy as slapping on a tax thinking that's going to be warn off foreign buyers. We know that the tax that was applied in British Columbia was a joke. Anybody who understands how house prices increase understand that as long as a foreign buyer purchases a property and holds on to it for a year, they will expect for their tax to be recoverable. We had to look at it from the large perspective. So with the Canadians' right to own policy framework, which we released today, this was actually supplied to David Eby back in July of 2016, right after the provincial Liberals had brought out the foreign buyer tax. Because at that time, the market was already correcting prior to the tax even being discussed openly in public anywhere. The tax is going to be applied at a time it shouldn't have been applied at, and the reason meaning that everybody was going to misinterpret how the market functioned after the tax was applied. They're going to make a whole bunch of false assumptions, which would lead to more bad policy, more bad decisions. We supplied them out with this policy. We have updated the policy and fine-tuned it because people now, the public has access to it, so we don't want to have any misunderstandings take place. So we had to set this policy in three different parts to cover all the bases. One is your foreign buyer tax, which we actually call the foreign owner acquisition tax. You apply a tax to any foreign owner who wants to acquire residential real estate in a municipality or in a province of between 8 and 17%. Now, people say, well, Ross, why do you have 8 to 17%? Why wouldn't you just say 17 or 10 or 12? Well, the foreign acquisition tax has to be applied depending on the density of the municipality where the tax is going to take place. In other words, Vancouver's density is a lot higher than Kelowna's. So you have to apply a higher tax on acquisition because there's a very strong possibility that as density increases, housing prices are going to increase, and any tax could be offset because of that. You see that all over the country, where a brand new high-rise condominium will be built, and comparing that high-rise condominium against one that was built in the 1980s. Now you've got 10-foot ceilings where you used to have 8-foot ceilings. Now you have gold-plated faucets or doorknobs. You used to have glass. You now have nickel-plated trim where it used to be a bronze-plated trim. All of these, your underground parking spaces have increased to 2 in those buildings versus 1 in the 1980s because the price point that they're selling the units at, the people have 2 cars. They're a wealthier owner. So you have to have the acquisition tax variable depending on the density of the municipality where it's there. You cannot set one set foreign buyer tax and have the percentage be correctly do what you want it to do, which is allow foreign buyers to become owners, but only the ones who want to live there, not the ones who are doing it as an investment, not the ones that are doing it on spec. Then you also have a foreign owner divestiture tax. Now, I believe they could apply this tax retroactively. They could actually give current foreign owners an opportunity to get out of the market before the divestiture tax comes into play. Because the reason for the foreign divestiture tax is so that any gains that a foreign owner makes by purchasing a property and holding on to it for a period of time, they're not financially rewarded for. Right now, you purchase a brand new condominium on a pre-sale in Vancouver, pay the minimal foreign buyer tax. Well, not be paying any foreign buyer tax, but let's say they bring the foreign buyer tax to cover condos, brand new builds as well. You're going to pay a small tax on your new condominium. 3 years from now, when your condominium is finally built, it's actually worth another 20 to 30% more than what you paid for it, meaning all of the tax is more than offset already, and you still haven't closed on the property. And existing Canadians who would have preferred to have bought the unit that you purchased basically on spec, they've been cut out of the market. So you've got to penalize or not incentivize foreign owners from speculating on those new builds, or in certain categories of homes like the ultra luxury class homes in Vancouver. You don't want to incentivize them to say, oh, that segment of the market is going to be under an increasing pressure from demand. That means that those particular categories of homes are going to increase more in value. We're going to invest in those on spec. You want to relieve that. We've done the relief through the foreign owner divestiture tax, where any net profits, now people will have to read the policy to understand how we've broken this down. Any net profits that a foreign owner has, 50% of it is taxed. So 50% of any profit that a foreign owner made while they owned Canadian real estate is paid to the government in the form of a tax. Then third, we had to say, you've got lots of areas in Vancouver where if the housing stock was rotated, in other words, you tore down all of the big detached homes on these laneway streets, and you rebuilt the entire block with townhomes, allowing planners and architects to design that block so that there's various styles of townhomes at different price points in the block to be built, all of a sudden you can take a large city block, including both sides of the laneway, of about 28 single detached homes, and you can turn that into 78 townhomes. Some stacked, mainly single townhomes, but you can do that. You can't do that when the government doesn't have a right to buy up those homes. The key time for the government to buy up those homes is when they're sold. So when a foreign owner who has purchased a luxury home decides to sell it, the government should be the first party that has a right to acquire that property from the foreign owner when they're selling it. They shouldn't have to get into a bidding war with developers. They shouldn't have to get into a bidding war with other foreign potential buyers. They should simply be able to offer whatever the current market value is of that property, and they should be able to purchase it, repatriate it at that price. They can use all of the taxes, Jim, through this strategy. So the tax that they collected at the time of ownership, the 15% tax that the foreign owner applied against what the foreign owner has made on the investment. And then they can take those funds and use it to purchase the property. They're purchasing the property not in competition, simply at its current market valuation. It's a great way for the city to gain control over its real estate and allow that real estate to be used to help their residents. They can grow the housing stock. They can increase density. They can improve affordability. They can offer more subsidized housing. They can work in conjunction with nonprofits or other government agencies. All of these things can happen through the right of repatriation. So the policy that we released today, it covered all of these things in a policy framework. The three parts that we released are designed to work together. They're designed to work together because that's how the home trading infrastructure works. It's how the housing market works. It's how the players in the housing market have interacted with one another for 50 years. It covers all of those things. Now, lawyers are going to have to get involved, and they would have to fine-tune the policy. The percentages may change up and down depending on what some other metrics that you were to come up with. But in essence, the policy is full. It's there. It's the solution that Vancouver and the rest of British Columbia has been looking for.
We'll have more with Ross Kay right after this.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, last week you tweeted a cryptic comment about saving a Toronto home buyer $398,000 on their home over a short 10 months. That seemed a staggering number, and our listeners are probably wondering how that happened.
How it happened, and I can understand why they would think it's staggering because, to be honest with you, Jim, when we received the email from that couple, it was really almost, I'm going to say almost life altering, but what I should be saying is business altering. And there's some irony because we've had some people out in your part of the country, out in Vancouver, where they have been over $800,000 that they have saved following the advice that they were given. And in the case out in your way, some of these items have even been gone to court. So it's not like we're talking off the top of our heads here. These are actual court case documents where these price valuation changes have moved. When I hear about financial advisors and I hear about the financial community talking to people about investment stocks, bonds, savings accounts, financial planners, that sort of a deal. I understand the importance that those people serve, but I had really not realized the magnitude of what a homeownership consultant, a home equity management program is. And when this letter came, Jim, email came. It was really revolutionary here for us here. This is someone who was being counseled by everyone in their family, all of their realtor buddies, their bosses, everyone you can think of was telling them to purchase a home in Vaughan last March. They were encouraging them to purchase the home in Vaughan when housing prices were skyrocketing, supposedly at the same 30% like people in Vancouver have been told back in 2016 was happening. Both false numbers, but that's what was being reported in the newspapers. The exact same story was being told to this couple. Oh, you're making a mistake not buying. Why are you listening to these people? They don't know what they're talking about. How real estate can only go up, up, and up. Well, they believed the information that we provided to them. They trusted what we had told them. Now, I know that they were listeners of Howe Street. So they probably had listened for a very long period of time of me speaking here. I didn't know that they were making this decision until after the fact when I was forwarded their email that was sent to support. These people didn't buy. They had a house they were going to buy in Vaughan last March. It was a newer property, somewhere around the 6 to 7 year old range. It was $1.2 million. $1.2 million. Last weekend, so not last week, the weekend before last, they went through an open house, the exact same subdivision, the exact same model of home, almost identical condition. I mean, no two homes are identical, so I'm not going to sit here and lie and say they were identical. Almost identical condition. They could have purchased that property a weekend ago, so not last weekend, 2 weekends ago, for $300,000 less than what they would have paid for it in March. $300,000. So it's not only the $300,000, it's also the point that these folks would have had to have mortgaged that $300,000 over 25 years. And realistically speaking, at a minimum cost, that would have been $98,000 to do that. That is $398,000 this young couple is not now looking to pay by following our advice. They are almost 400,000. Well, there'll be more than 400,000 after the weekend we just passed, because prices are still heading down in the type of home that they were going to buy. They are now $400,000 richer. $400,000 after tax. This couple would have had to have earned over $800,000 over the next 25 years to make up the difference that if they had purchased the exact same home in the city of Vaughan, just outside of, just north of Toronto, last March. $400,000, they would have had to have earned $800,000 of income to be able to pay off that debt. $800,000. The power of your home ownership situation. Your listeners, you know, it wasn't a big deal when it was $20,000, $30,000, $40,000, $50,000 when interest rates were dropping. You know, realtors or someone could give you the advice, and it really wasn't going to hurt you long time. But understand from this couple, they would have had to have earned $800,000 to make up for the $400,000 that they would have lost in the last 10 months. The people in Vancouver who were over $800,000. Now, those were people who had owned properties in Vancouver for a long period of time. So there was no mortgage interest associated with it. We're talking strictly capital gains, tax-free capital gains of $800,000 that they would have been responsible for. They're $800,000 ahead. This is not like gambling on a stock. This is not like trying to turn a 6%, 7%, 8% a year return on your stock portfolio into 12%. These are staggering, life-altering numbers that I'm speaking about here. This happens across Canada every single day. Home buyers are led down a path into financial devastation. This young couple is sort of like the poster child for what we're doing. And they're not the only ones, because sadly, there were other people in the exact same community who had the dashboards that was giving them the exact same information last spring, Jim, and those people bought. They didn't believe their dashboard. They didn't believe where housing prices were going to go. This couple is an example of someone who listened. $400,000 richer today, 10 months later. They don't have to earn an extra $800,000 to pay off that debt. The information that these people provided to us in this email, the thanks that they provided to us, it really sets a tone to how important homeownership information to the finances of not only the people who are participating in our programs or your listeners, but to our country as a whole. These people are now going to be able to have $800,000 of earnings to spend on something else, benefit the economy, help the needy, retire early. That's the great thing about what we're doing here today on your show.
We'll have more with Ross Kay right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Ross Kay. Ross, mortgage rates increased last week, and we've heard how some homeowners will not be able to afford those higher rates. Plus, we have that new stress test as well. What impact will those measures have on the market?
Okay, so great questions. I think we've alluded to these a couple of times on the show. The first thing everybody should know: the new stress test rules. Trade up home buyers are not going to be impacted by those rules at all. The reason why they're not going to be impacted is because that is not the buying pattern that home buyers, trade up home buyers, have followed for the last 50 years. In other words, home buyers that CMHC, OSFI, all of these consultants, all of these analysis, all these academics are talking about don't exist because for 50 years, homeowners have been smarter than that. They haven't moved under conditions that would allow these new rules to impact them. What do you mean by that, Ross? Well, first of all, we know that in British Columbia, when a trade-up buyer moves, the most mortgage they're going to carry is about they're going to go with 72% mortgage and 28% equity. So that automatically alleviates this 20% down myth. Then we also know that they're going to move only using about 26% of their income. So if you're only using 26% of your income at the posted rates, it means that as soon as you move up to the qualification rate, you're still well below the GDS, gross debt service, TDS, total debt service ratios that the banks use to qualify you. So we know that trade-up buyers technically will not be impacted at all by these mortgage rules. The rule that still is coming out into the market, the rule that is going to be impacting the market across Canada this spring is actually the rule the OSFI brought in November of the fall of 2016, when first-time buyers had to begin qualifying at these higher interest rates, the higher stress test, because they're the first step in the property ladder, or as we call it, the home equity pyramid. So we just take what I'm saying at its face value. Trade-up buyers are not going to be impacted by these rules. But first-time buyers who were impacted all by it last year are really going to start to show themselves in the market metrics, price metrics, as we move forward into 2018. If a first-time buyer is told by the bank that they can now afford an $80,000 house, where before the rule came in 2016, a $100,000 house, the first-time buyer will go out and search for an $80,000 home and buy it. That is what a first-time buyer is going to buy. Now, obviously, it's not going to be an $80,000 house. It may be $380,000, but I'm just using that number to make the math simple. That is a $20,000 reduction in what the seller of that property put in their pocket. Now, I'm not saying the house has dropped $20,000. I'm saying the home that they purchased was $20,000 less. That means the owner of that $80,000 house going out and buying, he is purchasing a home that is impacted by having $20,000 less in his pocket or their pockets. That $20,000 less in the next trade means that you're looking at about $80,000. I've been there, just off the top of my head, about $80,000 less home that they're going to purchase because of the way that the rules are impacted. So, in other words, instead of going out and purchasing a $200,000 house, the owner of a $100,000 house would. The owner of an $80,000 house has to go out and purchase a $160,000 house. They find up a little bit of difference to make up some of the difference. So now we're at a $40,000 drop. Even though the housing prices are the same, what they're buying has dropped in value, which is why we've told everyone on your show for 3 years, house prices are a buyer side metric. They've got nothing to do with house prices. They only have something to do with house prices when you're dealing with realtors and appraisers and the bank, because they're going to allow that house price illusion to become real through financing the property. But that's why you have a house price correction, because that illusion has to be wiped out. And I've just told you where we've lost a first-time buyer who had to pull back $20,000, causes a $45,000 pullback on the first trade. On the second trade, it's not a $200,000 homeowner that's moving, it's a $160,000 homeowner moving. And now we start to get into some real math, because now it's a $100,000 reduction. So even though all of those trade-up buyers still qualify for the exact same amount of mortgage that they would have had anyways, the only difference is how much home equity they're carrying with them into the next purchase. And that home equity is carried forward in each subsequent trade up the property ladder. That's how you have people who, how in the heck can they drive a Toyota Echo and live in a $1.5 million home? It's because their mortgage is smaller than you think it is. They carried home equity that was passed up through the home equity pyramid from one home to the next until it got to them. And then they went out and bought the home. Home equity pyramids also work on the way down, folks, which is why you get a contracting market, which converts to a correcting market, which possibly moves into a real estate crash. So when people are out there saying that the second set of rules is going to impact the market this spring, they're wrong. It's the old rules from November of 2016, which are now starting to impact the property ladder that is going to be recorded. Because I will assure your listeners, when you look at the mortgage data 2 years from now for 2018, it will be the exact same mortgage data that has existed from the 1980s through till today. Because home buyers move on the exact same pattern. They have lived a life where they have been funneled down this path, and it is the only path that, 85% of all home buyers follow. There's always outliers. There's always lottery winners. There's always someone who gets a great promotion, who hits the jackpot and sells their company. But the vast majority of Canadians follow the exact same path. Home prices that are going to be impacted this spring are a consequence of the November the 2016 rule changes, not the rule changes that took place January 1st of this year. Those rules, those impacts won't be recorded till 2019 and 2020, because then there probably will be a behavioral change to trade up home buyers long term. And that's basically a breakdown of that one, Jim.
Ross, thank you so much for chatting with us.
Hey, thanks for having me back.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. Any questions for the show can be sent to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.